Hi, this is Les Goss. This is a recording of a presentation that I did at the initial Colorado Springs Note Closers meetup group, and I've had several requests to record it so that people could either hear it again or for the first time if they weren't able to be in the original meeting. So we're going to be talking about investing in notes, specifically performing notes, which are mortgages that people have been paying on for some time, and we anticipate they will continue to be good payers. So we'll start back in 2008, and you probably don't remember the exact date, but you do remember when the stock market went crashed halfway down practically, and we all lost a lot of money out of there if we had any in there. And so a lot of money went out of the stock market, and the question was, where are you going to put it if you don't want it in the stock market? Here's a series of jagged climbs and falls that the stock market went over in the last 12-month period ending last October. And as you can see, it goes up and it drops and it goes up and it drops, and you just have to ask yourself, what is coming up next? This is a longer term one where you can see starting from 1995 to 2014, a period of 20 years, that the market started, climbing and climbing and climbing. It looked like it was going to go on forever. Of course, then until it didn't and came down pretty hard and then rebounded and went up and up and up, and it looked great, and this is the big bubble, and then it crashed again. And now it's been going up and down and up and down, gradually going up though, pretty high numbers. But again, we have to wonder, what is next? Is this what we've been writing? This is the way it feels sometimes when it's really exciting and you're going up and everything's great, and then you're going sideways and down, and it's pretty scary. So some people have taken some of their money that they would have put in the stock market and as an alternative investment are finding out about real estate backed notes. And that's what we're going to be talking about today. So we'll start off with the basic question, what is a note? And the answer is, a note is basically any promise to pay. It comes in a lot of different forms. We're familiar with that one. If you write a check, you're promising to pay to somebody else, but it's not gold. Here you're promising to pay for your car. And the one that we're going to talk about is the note where you promise to pay for a house. So a mortgage note is made up of several factors. It has to have the total amount that you're borrowing, the interest rate that you've agreed to pay, how long you have to pay it off, and what the monthly payment's going to be. And then you sign it and give it over to the lender. So we're going to back up just a step and see how that note might have been formed. We've got someone with a house and he wants to sell it, and he thinks he can get $110,000 for it. And he's found a buyer who thinks that that's a good value and would like to buy it. The problem is he does not have $110,000 in cash. So we know we're going to have a bank brought in or some kind of mortgage lender. And the buyer does have a $10,000 down payment, so he can pay that to the seller. But he needs to borrow the $100,000 from the bank or the other lender. So he gets the $100,000 from them and signs that note that we just saw, promising to pay, and then he's got the $100,000 that he can give to the seller. Now the seller has been made whole. He's got everything he wanted out of it. So now he's in a position to transfer the ownership of the house in the form of a deed, which he signs and passes over to the buyer. So now the buyer is the owner of the house, and he's given the bank a mortgage and note so that the bank feels protected and has a long-term cash stream coming to it. Now into this scenario, we get an investor who wants to buy that mortgage note, probably, definitely at a discount from the bank. And so he swaps his cash for the note, and then he is the one who's receiving the payments from the buyer. And that's basically what we do when we buy notes. We buy it from the original lender at a discount, and then we have made it so that the cash payments go towards us. It's critical to know we have not bought the house. We have just bought the paperwork that moves the payments from the buyer to us, but the buyer is still responsible for everything about the house himself. Here's an example. This is Joe LeCount, who's given us permission to show one of his deals. Rogers, Minnesota. Looks like he goes to the same barber as I do. This is the house that he bought in Florida, Ocala, Florida. It's a double wide with land. It's a 3-bed, 2-bath, just under 1,400 square feet. The current market value has been assessed at $42,000. So this is a performing note because he's been paying on this for some time, and we assume he's going to continue. So Joe bought this note for $31,000 and change, and you remember that the value was $42,000. He bought the remaining 203 payments. This was originally sold to the buyer on a 20-year note, 20-year loan, so 240 payments, which means that the original buyer, who's still in the house, has paid off 37 payments. He's got 203 left, which is what Joe bought. So since he's got value above his purchase price, that's his buyer's equity that he's got right there, and he's also got the comfort of having 37 payments already been made. He has a mortgage on the house in Florida, so that if anything goes wrong, he has the first opportunity to get that property back if for some reason the buyer decides not to continue paying or is not able to. Now Joe, in this case, decided that he had some money in an IRA that wasn't making much money, like zero probably. So with the proper type of self-directed IRA, he's able to use that money, and the IRA is actually the purchaser of the note, not him personally. So every month, the $318 that's payment up for this note goes into his IRA mailbox. And that's just about as easy as it gets once it's set up. Pretty passive there. So over 203 payments, he's going to net or gross $64,554 for his $31,000. So he's made his money back and then quite a bit more over that period of time. That's an effective annual interest rate of 10% to Joe. Now what we do is we buy the entire note and then sell the front part of it to an investor. And let me talk to you a little bit about what they call the time value of money. Basically, money that you get today is worth more than money in the future. So if I said, would you like to have me pay you a $20 bill today, or would you like to collect that in a year from now? And everything else being equal, you'd probably say, heck, give me the money now. I can spend it. I don't have to wait for it. I know it's worth 20 bucks. And so I want my money now. It's worth more than money in the future. As another example, let's take this $318 and go shopping with it. Let's go to, let's say, Walmart. And we're going to go in there to buy staples. We're going to buy some groceries and some paper products and cleaning products and just a few of the usual household items that we need. And we've got $318 to spend. So if you go into Walmart today, I want you to think about walking out with all that stuff you bought. How many shopping carts will you have filled up? We should think about that for a minute. What will $300 buy you today at Walmart of your basic stuff you buy every month? Well, you'll probably end up with several shopping carts, depending on what you bought and how full you fill it, but maybe 2 or 3 or 4 shopping carts, depending, for your 300 bucks. Now I want you to go back in time to 1986, the middle of the Reagan years, and I want you to go into the Walmart of the day with your $300 and buy the same kinds of stuff, and imagine how many shopping carts you can fill up back then in 1986 with your $300. My guess is you will determine that you're getting more. Whatever you came up with for your number of shopping carts, you realized you probably could have filled up more of them back in 1986. Now, if we go forward 30 years from now to 2046, and you take that $318 in, think how many shopping carts you'll fill up then buying the same sorts of things. I don't know what number you'll come up with, but my guess is it will come up with less stuff than you were able to buy today. And that's because the money in 30 years probably won't be worth the same amount it is now. So what we do is we sell the front part of this. In this case, for this demonstration, we'll sell the first 120 payments to an investor. So they're getting the front end of the note, which is the most valuable because it's the closest to now. So they're getting their money right now when the money is still worth close to $318. We will keep the back end for ourselves. So we've got 83 payments, but you can be sure that since we're not getting paid until your 120 payments are completed, if I'm the seller here, if I bought this long-term note, I'm going to be motivated to make sure that things go well for you so that I still have my payments that I can collect later. So let's say you're the front-end investor. You buy these 120 payments for $24,000, and over the 120 payments, you are going to collect $38,160. So that's a 10% annual yield. Now, on the other hand, I've got your back literally, and I'm making sure that everything's going well at your end, and I will have a smaller investment and a short-term investment, but it's pretty far out in the future. And what we've just described is what's called a partial purchase, because you as the investor have just bought part of the note. Now, here's a graph that will take a little bit of explaining. The gold bar or semicircle starts up at the $31,000 that I paid for the note, or in this case Joe paid for the note, and it pays down over 203 payments until it's paid off, and then we're done. Now I've sold you the $23,000 worth, and it starts, and you're getting your payments instead of me for the next 120 months, so you get your payments until you're all paid off at that point, and then I start getting my payments back here. Now, several things could go wrong. One of the things that you might worry about is, what if the guy pays it off early and I don't get my 120 payments worth? What happens then? Well, let's take an example. You're anticipating getting 120 payments. That's what you paid for. But the guy refis or sells in 5 years. Maybe he decides he can finally get a bank loan at 4 or 5% instead of the 10 he's been paying. And so he refis, cashes out the our loan and pays us off. Or maybe he just sold the place and we get paid off that way. So how do we figure out how much you get if you get paid off early? Well, we look at this chart, and we'd actually look at the amortization schedule behind this, which is the spreadsheet that shows each month how much has been paid off for principal and interest and how much is still due. And after 60 months of this payment, of these payments, he still owes over $26,000. Now, how much are you owed? You're owed what's left from right here where we stop the payments over to here, and it looks like about $15,000, and in fact very close to that. $14,976 is what you're going to get back on that happy payday. So instead of your $318 that month, you get a check of almost $15,000. Now you've also got, over the 5 years, you've gotten $19,000 at a monthly payment. So your total is $34,000, and you didn't have to wait 120 months to get it. So it accelerates your return, so that's a good thing for you. And then I would get the balance after that. You're still getting your 10% interest on the loan. Now, all the investors that I deal with, once they figure this out and they think this is the way to go, they're happy just to put in their money and collect their payments. They don't want to deal with all the checks going back and forth. They don't want to deal with the buyer if he's late by a week. They don't want to collect for taxes and insurance escrows. They just want to put in their money and get a return. So how do you do that? And the answer is we hire a loan servicer. A loan servicer is the one that basically does all the work that I've just described. So they're going to collect the payments. They're going to do the escrows for taxes and insurance, pay those off when they come up. They're federally licensed and they're compliant with the Dodd-Frank regulations and all the other rules and regulations that control the real estate market. And that's very important. You don't want to be doing this on yourself and do it wrong and get a lawsuit at some point. So these guys know what they're doing and they keep up with the changes in the laws. And if something goes wrong and the buyer gets behind, they're qualified to do what we call a workout. See if they can get the guy back on track, or if not, get the property back. So then the money is going to the loan servicer, and the loan servicer takes out their fee for all the work they're doing and sends us the balance, sends you the balance as the note owner. So this is your basic passive deal. And the way we've made it passive is we've outsourced a lot of this work that we don't want to do to a servicer who's fully qualified and experienced to take on this kind of work. So that's the key to owning a note without having to manage it. Now I know you've probably got a lot of questions after that, and I invite you to write to me or call me, get in touch with me somehow, and I'd be glad to answer any further questions you might have. So that's it for now. This is Les signing off. Hope you got some good value out of this instruction. Bye.